What's up guys, welcome back to InvestingPH. I've been a big fan of dividend investing. If you watch my videos, it's full of dividend content because I just love the thought of making money without doing anything. There are a lot of advantages to it, like the best one is, even though the market is down or stagnant for a long time, you are still making money while waiting for it to recover or go up. It gives you that sense of security. This is what's happening in the PSC market for the past couple of years. Ever since the pandemic, our market hasn't yet recovered. It's nowhere even near recovery yet, and even further than its highest point way back in 2018. But even though the market has been stagnant for years now, I was still making money, all thanks to dividends. Last year, I had a record high of 122,968 pesos, or a monthly average income of 10,247. This is like having a small rental condo, and right now, if all my stocks pay the same amount of dividends as last year, my estimated dividend income in 2024 would be 161,251 or 145,125 pesos after the 10% tax rate. Now I got this amount in just under 5 years as I've been investing consistently every month, and I'm putting it in companies I've researched well myself, companies I think are strong, will continue to grow in the future, and have a good dividend track record. I don't just focus on yield alone, I focus on the quality of the company first. So this is what I'll show in this video. I'll show you 5 companies I believe fit these criteria, and of course, these are also companies I'm currently invested in. First company and the best performing stock in my portfolio, DMC Holdings. Their businesses range from construction, real estate, power, mining, and water distribution. Ever since I got this stock, it has given me 55,080 pesos worth of dividends, though it doesn't look that big. If you factor my invested money in this of only 91,000, I've already got 60% of my money in just under 3 years. I got such a high yield since I bought it for a very cheap price during the peak of the pandemic. If you look at how well the company is earning money, revenue and earnings have grown well over the years. Their growth went even higher after the pandemic. And looking at their equity, consistently growing as well, had a huge jump in 2022 and 2023. As to how well the company is handling its debts, it only has a debt-to-equity ratio of 0.71, which is very low. This means that for every 1 peso of equity, they only have 0.71 pesos of debt. For its dividends, the company has a 13.8% yield, even though its price has risen, and they had been consistent in their payout for the past years, and even increased it in the past 2 years. Their payout ratio is only 34%, which means they have a lot of their earnings left to be reinvested back into the company, to be used in further growing their businesses. As to their valuation, even though the stock price has increased and even surpassed its pre-pandemic level, PE ratio is only 5.9 and price to book is 1.2. This means if you buy right now, you're buying 1 peso worth of equity for 1.2 pesos, so still quite a good deal. As for my computed intrinsic value, it is 11.49, and with a 30% margin of safety, I have a buy below price of 8.04. So as of right now, although it's trading below the computed intrinsic value, I always give a 30% margin of safety for my buy price. The price is beyond it, the yield is still quite attractive if you're just in it for the dividends. Even if the company doesn't pay their special dividends this 2024, the yield still sits at around 7%. Second is China Bank. The price of this stock has already risen, but it still boasts a good dividend yield. For its financials, it has been setting new highs every year. Even the pandemic didn't shake its revenue and earnings. The same goes for its equity, consistently increasing every year. Now for banks, I don't look at debt ratios. What I look at to assess its risk is its loan-to-deposit ratio, which compares the total loans the bank is giving to its total deposits. A too high ratio for this means the bank does not have enough liquidity to cover any unforeseen fund requirements like a sudden big withdrawal, and too low means the bank isn't using the money it has to earn as much as it could. This means the money is just there stagnant. For China Bank, they have a 65% loan-to-deposit ratio. Usually, the typical for this is in the 80 to 90%, so it's on the safe side. This means it has enough funds in its hand for any sudden big withdrawal. So this just tells me they still have a lot to use. They can even increase their ratio for this to earn more money. And this is on top of their already consistent earnings growth for the past years. As for their dividends, they are also giving a strong 6%, and they have been consistent with their payout and have even increased it, and they are only paying 13% of their earnings, which means they have a lot of left to grow and expand their business. For their valuation, PE ratio is only 4.1, which is quite low. In comparison, the PSCI is trading at 12 times its earnings, and comparing to its peers, China Bank is trading at a discount. Same with its price to book of only 0.6, compared to its peers, still quite undervalued. So even though its price has increased over the years, its valuations are hinting that the company is still undervalued. For my intrinsic value computation, it's 45.38, and with a 30% margin of safety, my buy price is 31.77, so a tight buy for its current price of 31.55 as of the creation of this video. Now before we move on, if you're curious as to where I get all these data, it is from Simply Wall Street. Back then I was jumping from website to website just to get all these, but now it's all here. And the best part of it, the way they present it is so clear and easy to understand. So if you're a beginner investor, you should definitely try this out. And there's more. They also have a watch list where they notify you if the company releases its earnings and dividends, when insiders are buying or selling, and when the stock falls below its intrinsic value. That's right, if you don't know how to compute it, they have it for you as well. But for me, you should still put a margin of safety to it. They also have a portfolio tracker that lets you assess the overall health of your portfolio. So if you want to try it out, they offer their basic plan forever free. And if you do want to avail of their paid plan, then by using my link, you can get up to 40% discount, which is limited to the first 100 subscribers. So better grab this opportunity now and try Simply Wall Street. Now back to the video. Next up is another bank stock, Metro Bank. Though they have recovered quite a bit, it's still nowhere near its pre-pandemic price. For its financials, though their revenue and earnings were affected by the pandemic, last year they have broken past their pre-pandemic level. The same goes for their equity. And as for their loans to deposit ratio, is almost at the same level as China Bank with 68%. This means they have enough liquidity. And for its dividends, it gives a good 5.3% yield, and they have grown over the years. They are also consistent in their payout and sometimes give a special dividend. Their payout ratio is only 17%, which means they can easily maintain this and have more left to grow and expand their business. As to how it's valued, price to earnings is only 6.2, and compared to its competitors BDO and BPI, it's trading at a cheaper valuation in relation to its earnings. Same for its price to book of only 0.7. So for a large bank like Metro Bank, we are getting it for less than the value of its equity. And for my computed intrinsic value, it's 81.44, and with a 30% margin of safety, my buy below price is 57 pesos. Fourth and my second largest holding, LTG. Their businesses are tobacco, banking, milling, alcohol, and real estate. Their stock price hasn't yet recovered past its pre-pandemic level. For its financials, revenue and earnings, although have their ups and downs, but overall have gone up. Although their earnings and revenue are growing, investors are afraid to invest in the company because of the tax imposed on their tobacco business, which is said to increase by 5% a year. This affected their earnings because of the lower volume caused by the industry-wide price increase of tobacco in the third quarter of last year. But the decrease in their net income isn't too drastic because their other businesses had good growth. Their bank holding had an 18% increase, which now takes up 40% of their earnings compared to 32% last third quarter of 2022. Distilled spirits up 34% and now take up 6% of overall earnings. Beverage up 5%, property development up 4%, VMC their milling business up 53%. With this increase, their other holdings now comprise 53% of their earnings. That is why I'm not at all concerned about this company, as I know they are growing their other businesses and their tobacco business is still up and running. The same goes for its equity. They have grown consistently every year. For their debts, since LTG has a bank holding, if you compute their debt to equity, of course you would have a very high number. Good thing is, on their website, they computed this for us. Their debt to equity ratio without their bank holding is a very low 0.13. This means they only have 0.13 peso of debt for every 1 peso of equity. Now for their dividends, LTG has a dividend yield of 13.2% and they have been consistent in their payout and have even increased it over the years. Now what contributed to their high yield is their stock price plummeting hard over the past years. Though its yield is high, its payout ratio is only 7%, which means they have a lot of their earnings left to be reinvested back to the company. As for its valuation, PE ratio is only 4.1, and price to book is at a low 0.5, so we are buying as well their equity at half of its price. For my computed intrinsic value, it's 14.57, and with a 30% margin of safety, my buy below price is 10.20. Last is Globe Telecom. Well, for me, this is the best telco here in the country. It not only has business in telco, but also digital wallet, kick-startup ventures, internet, etc. For their revenue and earnings, they have consistently grown over the years, the same for their equity, which had massive growth for the last 2 years. The only downside is their debt to equity is quite high, at 2.84. But to assess this further, if we compare it to its rival PLDT, which has a debt to equity of 4.39. Now it's different from what you can see here in Simply Wall Street, as what I use is total liabilities divided by equity, which you can get in the same panel, just divide it 2, because what Simply Wall Street shows here is short-term debt divided by equity. That's why it's lower. For its dividends, Globe has a dividend yield of 5.7%, and they had been consistent as well over the years, slowly growing their payout. Though their payout ratio is not as low as the other companies I've shown, it's still an acceptable payout ratio of 55%. For valuation, price to earnings is 9.7, lower than PLDT, but slightly higher valuation than Converge, which has a PE ratio of 8.3. And for price to book, 1.6 times its book value, lower than PLDT and slightly above Converge. And for my computed intrinsic value, it's 2,702.74, and with a 30% margin of safety, my buy below price is 1,891.92. This is drastically lower than my last year's computation of Globe, as their EPS is lower now compared to last year, which was their highest, as my computation is based on earnings. Now another dividend stock I want to mention that has outperformed in the past months is Shang. Its dividend yield sits at 7.4%, payout ratio is only 28%, and has been consistently paying dividends for years now, and has even increased it. Earnings and revenue, like all real estate companies, were hit hard during the pandemic, but now it has reached record levels. Equity the same, have consistently gone up. Debts are managed well, with debt to equity only at 0.50. Valuation, although its price has increased, PE ratio is only 3.8, and price to book at 0.4, so still undervalued. For my computed intrinsic value, it's 4.91, and with a 30% margin of safety, my buy below price is 3.44. Added this stock because it has strong financials, managed debt, growing dividends, and though its price has gone up, is still quite undervalued, and I believe this company would still grow in the future. So this is it for this video. I hope you've learned something, and if it did and still haven't clicked the like button, I'd appreciate it if you do so before leaving. Thank you, and see you in the next video.